Are you also a trader who is scared of candlestick wicks? Sometimes they get you out of good trades too early, sometimes they keep you out of good trades because you are too scared to jump in when you see a big wick. And if that's the case, this video will help you understand wicks in the right way, and I prepared a lot of tips and tricks that will help you master wicks and trade them successfully. If you would be long and you'd be seeing this candlestick wick, what would you be doing? Would you be scared out of your trade? Would you close it because you think this is a rejection? How would you handle it? I've been working with hundreds of traders over the last 7 years, and very often we are talking about wicks, and a lot of traders, I see it almost every day, gets easily scared out of their trades because they have a wrong understanding of what a wick is. So we see a pin bar, we have a big rejection candle, but what else do we see here? First of all, we are coming from a huge bullish momentum push. You can see we have 1, 2, 3, 4 very strong bullish candles in a row. And then we have a tiny consolidation, one small red candle and a small inside candle, and then this big candle. Also, this huge candle gets us out of this consolidation. The price is closing above the highs, and it seems like it is resuming the trend direction. The trend direction is clearly higher. However, a trend doesn't just go in one straight line, up or down. There's always this back and forth. So it's very natural to eventually see a consolidation, and a wick or a pin bar is not a very uncommon consolidation candle. However, in this case, we cannot argue that this is a very bearish signal. And especially when we now go to the lower time frame, so we are going from the 4-hour to the 30-minute. This is the pin bar that we're seeing on the higher time frame. What is this pin bar showing us on a micro level? It shows us a break and retest structure. This is the very strong bullish push we've seen on the higher time frame. This is the small consolidation. The candlestick broke out here, or the price action broke out, and it's retesting the previous highs now as support. This is not a bearish signal whatsoever. This is quite a bullish signal as long as the market can stay above this range. So to begin with, this is not a bearish signal, and if you take a look and put the candlestick into the right context, if you go to the lower time frame to see what is the candlestick actually looking on a micro scale, you will gain a very different view on the markets. And now if we move forward a little bit, you can see that after the retest, the market rallied higher, made another bullish push, then another consolidation, broke out and moved higher. So it's a very natural rhythm of the markets. And just because you see one candlestick on a higher time frame, that's not enough to get you in a trade, get you out of a trade. It's not enough basically to make any analysis on any chart. You have to look beyond the single candlestick, look at what has happened previously, what trend context is the candlestick happening at, and on the lower time frame, what is the pin bar, in this case, telling us, what is it showing us on a micro level. And then you can see when we jump back to the higher time frame, this is the big pin bar that a lot of traders would probably get scared out of their long position. You can see afterwards the market continued higher, made a push. You would expect to see a reaction at a previous high, nothing uncommon. You have a little bit of a retracement and eventually push higher. So a very, very important piece of information to just the beginning of this video. Another example, and here we would be looking at a potential reversal, right? We have a long mature uptrend. The market made a double top, made a lower high, and probably a lot of people were looking for a potential bearish breakout, but then they see this candlestick wick and they think, okay, now this is not a bearish signal anymore. It's time to buy because this wick shows us that the market rejected the lows, right? But let's continue and let's see what else we can find here. So first of all, we have this big support and resistance level that we need to draw. Previous resistance seems to be turning into support, and this is where the wick is happening. So let's jump to a lower time frame and let's examine what we see in this zone on the lower time frame. On the lower time frame, this candlestick wick is this area here. And what does it show us? It shows us that the market broke below the previous lows. The market was not able to close beyond this point here. So this is the lowest low previously. The market broke lower and is coming back into the previous support, now retesting as potential resistance. Again, this is not a bullish signal at all. And the wick that we see on the higher time frame is not necessarily a rejection. It could be just as well be a retest pattern. So as long as the market doesn't break above this area, the wick is not showing us a bullish indication or is not giving us any bullish information. On the lower time frame, we can see the wick is actually just a retest on a micro level. And this is what happens afterwards. The level held, the price action was never able to get above it. So the wick was never actually a sign of rejection. It was a sign of a retest, and the retest then continued to hold, and the market afterwards collapsed. And if we jump back to the higher time frame, you can see that the wick is not a sign of rejection necessarily. Sometimes it can be, depending on the whole context. However, in this case, it was a retest pattern. The retest held, and then the market really did roll over. In our third example, we are looking at a double pin bar. We have two pin bars happening right here. Is this a sign of rejection? Should we go long here? And what are we missing? So first of all, we look at support and resistance levels, and we look at what is currently happening. So here's a very strong support level, one support twice, 3 times, the market broke below it and is now staying below this. Also, here's a very major demand area. The market shot up higher from here, and the market is back here. And also we have the origin of a trend. This is a distribution or accumulation pattern. The market shot up higher, and here was the origin. So naturally, there's a lot of buying and selling going on, and the market has the pin bars happening right here at this accumulation zone. So it's natural that we'll see some indecision. The market just broke below previous very strong support level, and it's above this resistance, previous resistance, now turning into potential support. So naturally, you will expect a little bit more noise. What you can ask yourself, what is the path of least resistance? Is it higher back into this range? You can see what happened previously in this range. We have a flip here, we have a lot of noise here, we have a lot of trading activity around here, and there's in general just a lot of stuff happening inside of a range. So trading into the middle of a range is not the path of least resistance. To the downside, you can see we don't have much. We just have this accumulation phase. So the path of least resistance seems to be to the downside, right? Let's take a closer look, and let's go and look at the lower time frame. First, we could add a moving average. The moving average is a very objective tool to analyze the price action. And as long as the market is below the 50 SMA, we are not bullish yet. It is a filter to distinguish between bullish and bearish markets. And as long as the market is below the 50 SMA, we are more bearish than bullish. Also, we can look at previous high and low structure. You can see the market topped out here at the top. And since then, the market kept making lower highs. This lower high structure is still in place. Here's the last high. The market is still trading below the high. And that is also not a bullish signal. It's more of a bearish signal because we are still technically in the downtrending market. We could come up now with a trading plan. First of all, a bullish trading plan would lead us back into the range that I've shown you, and a bearish plan would lead us back into the accumulation zone that we have seen on the higher time frame. Also, the bearish trading plan is more in line with the higher time frame, and also here we can see that because here's the downtrending structure, lower highs and lower lows, and below the moving average. And therefore, we could favor a short scenario. The market broke out, so that is actually what we would like to see because it's in line with the higher time frame, and that's what's happening. And you can see, if we follow along, you can see the market continued its lower high structure. It was never broken. The market continued to make lower highs and lower lows. And now when we jump back to the higher time frame, this is the double pin bar, and the double pin bar at no point in time suggests that we should go in a long trade. Of course, it's not the most bearish signal that you can find. However, it is not necessarily a bullish signal. So whenever you see a pin bar or a wick, I would caution you to draw fast conclusions. Look at the whole picture, go top down, and look at what is happening overall. And you can often make much better trading decisions. Now let's look at a very, very important price study. And a lot of traders, when they see a chart like this, maybe they're long, they will think that, oh no, there is a wick and I should get out of my long trade because this is a bearish sign. Or other traders who are not in a trade will go short because they believe a wick is showing us rejection. Let's look at it further and let's see what we else have here. First of all, the market arrived at a previous high, and it's natural to see some type of reaction. A lot of people will have stops, targets there, and therefore you can expect a little bit more volatility. So it's not unusual. Also, what is good here, for the bulls at least, is that the market closed above this. So it's a very strong bullish signal. When we drop to a lower time frame, so we go from the daily to the 4-hour, we can see that this pin bar here on the lower time frame, keep in mind the daily candlestick is 6 candles on a 4-hour time frame, and the 6 candles here show us a break and retest structure. We broke out and we are now in the process of retesting this area. This is not a bearish signal at all, as long as the market doesn't fall back lower. We can see now the retest is continued, the market is struggling to break below that, the level is holding, buyers are defending it. And again, when we look at high and low structure, we can see this is always in place. The market keeps making higher lows, which is a very bullish signal. We could add a 50 SMA to have a little bit more of an objective measurement for the trend direction. And as long as the market is above it, we are more bullish than bearish. A little bit later, the market is back at the highs. We have a breakout buildup, and you could make trading plans. Trading plan long could be break and retest. Trading plan short would be a break and retest below the lows, below the moving average, and also below this major support and resistance level. However, I would favor more the bullish trading plan because that's in line with what we are seeing on the higher time frame, mainly the huge bullish pressure and the huge momentum. A bearish trading plan I would not be so comfortable with because it's against the higher time frame. And shortly after, you can see we have a breakout, a dirty retest, staying above the moving average, and the market continued higher. So having a better understanding and having actually a more nuanced view of what a candlestick on a higher time frame looks like on the lower time frame, how to put it into the right context, what are trend information that we can pick up, that will help you make much better trading decisions. You're not easily scared out of your trades when you just see a single wick. And keep in mind, just a single wick is not a lot of information to base a trading decision on. So we have to come to a more sophisticated idea. We have to look at microstructure, and then you can make better trading decisions and avoid unnecessary mistakes.